Hello guys, welcome back to our second class. I'll be introducing you to the Forex synthetic market proper, as we've discussed in our last class about the type of markets we have under the financial market. So I'll be exploring the Forex synthetic market with you guys, and I also let you know the other type of markets we have, like the stock market, the Forex market, the bond market, the commodity market. As we have all those type of markets, we also have the Forex synthetic market, and I'll introduce you proper to the Forex synthetic market, the instruments that are traded in the Forex synthetic market, how they are traded, how they can be traded, and also introduce you to the broker that offers synthetic indices, which is Deriv. So let's go on. So I'll start by letting you know that Deriv is one of the world largest online brokers offering CDFs and other derivatives on forex stocks and indices, cryptocurrency, commodities, and derived to millions of registered users across the globe. So Deriv is a regulated and recognized broker, and it is only on Deriv that you can trade the synthetic indices. So let's move on. I will let you know what synthetic indices is. So the instruments that we are focused on is the synthetic indices when it comes to the Forex synthetic market. So I will start by letting you know that the Forex synthetic market is a simulated version of the real Forex market. So it's not a real market. I mean, it is not connected to the real world. Like when we talk about other markets now, like the Forex market, every activities that go on is real life activities. But when it comes to the Forex synthetic market, it is a simulated version of the real world. So it is not connected to the real world like the US dollar or euro, right? So instead it uses artificial currency pair created by broker. So it is artificially generated. So yeah, so that's what synthetic indices is. So I'm going to go on with I'm going to go on with telling you that synthetic indices is different from other type of markets. With it has different it has some differences with the other types of markets. So the synthetic indices, they imitate the real world, as I've said earlier. However, there's a twist. They are not affected by global events, and these indices are strictly based on random numbers generators. They have constant volatilities and are free of liquidity and market risk. They are controlled and checked by an independent judge, ensuring that they cannot be manipulated. It's just the same thing I've said before, that it's a market that just imitates the real life trading markets. So everything that I've said, I'm going to break it down so that you can get it, because you have to know about a market before you can choose which one of the markets you want to explore. So that is what brings us to the difference between the Deriv and the Forex markets. So it's still the same thing. When I say difference between Deriv and Forex market, I'm just saying difference between the synthetic indices and the Forex market. So I'm going to differentiate it with some terms. Like number one, I'm going to differentiate it using the spread. So the most popular type of spread are fixed and variable. So the pros and cons between the two spreads can vary for every trader. In this case, Deriv provide their pricing with fixed spread, while Forex offer variable spread. So spread is simply the difference between the ask and bid price. I'm going to break it down a little bit more. For example, the ask and bid price is just like the buying price and the selling price. So example, maybe you want to buy a instrument now at $100, but before you can buy something, it means somebody is offering to sell. So you want to buy at $100, right? And the person that is offering to sell will sell it at 102. So the difference between the amount you are buying and the amount the person is selling is the spread. So that's $2, right? So you want to go for a broker actually that offer a very tight spread. You don't want to buy an instrument at $100 and then it is being sold to you at 120. You see that the spread is very wide. The difference between the 100 and 120 is 20. So you would always want to go for a broker which offer a very tight spread, so that it will reduce your costs. So, but for Deriv, unlike the first market, which the spread varies, sometimes we have a very large spread in the market, sometimes the spread is low. But spread issue is a very common issue when it comes to the first market. But when it comes to Deriv, the spread is fixed. You don't even have to worry about spread. I've seen a lot of traders complain that because of the spread, they are not able to place the trade, or they can't execute some orders because the spread is wide. So spread is like a issue. It's sometimes an issue. Yeah, that's what I'm trying to say when it comes to the forex market. But when you're trading Deriv, the spread is always fixed. So that's one thing you should know. And next, I'm going to talk about news. When you're a forex trader, you watch out for news, economic news, and the global, what is going on in the world, what is going on. There's a lot of things that you have to watch out for when you're a forex trader, and news is a major part of it, because as a forex trader, what drives the markets is economic news, economic activity, right? So there are different type of news that comes out that that provide volatility in the markets. You probably have had some news like CPI, NFP, PPI, all those things, all those news. People that are exploring the forex markets, if you haven't heard about it, you get to know it as time go on. So news is something that we watch out for as forex market traders. So reasons are because the major moves occur in this period, and it comes with volatility, which is risky to trade. But on synthetic markets, you are free from this. The market is not affected by any economy or news that results to unexpected high volatility moves in the market. So unlike the first market, where you just see some huge surge in the market, spikes and all that, in the Deriv forex synthetic markets, there's nothing like news. There's nothing like unexpected volatility in the market. Everything is fixed. Everything goes at its own pace. So there's no news when it comes to the synthetic indices market. So those are the difference you should take note of when you're trying to settle for an option, like the type of the markets you want to explore. So you just take note of all those things now. Then we also have sessions. So when I talk about sessions, there are different type of sessions when it comes to trading forex, right? So a day a trading session is a time of the day when the market is open to exchange assets. The different locales and markets have different trading hours. Also, the market opening and closing times vary with assets classes being traded. So what is different when it comes to synthetic? Yeah, the market does not have a closing or opening time, and it is not moved by any economy. It's not moved by any economy. So what I'm trying to say here is that when it comes to the Forex market, we have different type of session. You'll be hearing London session, New York session, Asian session, Sydney session. So there are different type of trading sections, and each trading section have its hour, the times that are like the different. So within a day there are different sessions that you can trade. So, and this session has different hour. Those that are looking to explore the Forex markets, you get to know about that. But when it comes to derived markets, when it comes to synthetic indices, there's nothing like session, there's nothing like opening and closing time. The market is always open, and it is not moved by any economy. There is no section when it comes to the synthetic indices market. So I think you get that. And also I will talk about volatility. So the main advantages of synthetic indices includes being well prepared for margin call, constant volatility, and the ability to trade without being affected by global events. While on Forex markets, it comes time when there's not much volatility in the market, and the global events occur and drive the markets, like the pandemic here. So when it comes to the Forex market, there are things that drive the market. Or so sometimes there are not much volatility. That's times that there are a lot of volatility in the market. And when I talk about volatility, I'm talking about the rates at which the markets move, right? So in the Forex market, the volatility is dependent on the economy, what is going on in the economy. I think like when there was pandemic here, in the world, I think COVID-19, the economy, there was no much volatility in the market. So all those like economic events, it affects volatility of the market when it comes to Forex market. And there are different type of economic activities. All those things, affect the volatility in the market. So if there is a news in the United States now, it's going to affect the dollar, the United States dollar. There can be a news that would make the dollar appreciate or depreciate, or all those things. So that's for Forex markets. But when it comes to the synthetic indices market, the volatility is constant. It's not moved by the economy, and you'll be well prepared for margin calls and all that. So since the volatility is constant. So also, I think this is the last one. Okay, it's not the last one. We have trading days. Like on the synthetic markets, you can get access to trade from Monday to Sunday, all the days of the week. The market is open for you to take advantage of. But this is different with the Forex market, as markets only operates from Monday to Friday only. So, and the Forex markets, the market only is open on the weekdays, which is Monday to Friday. Yeah, you cannot trade during the weekend. But when you're trading the Forex synthetic market, the market is opened 24/7, day and night, and the 7 days of the week it is open. You can trade on Sunday, Saturday, and all that. So that's another difference. Also, we talk about the broker choice. So I think in the last video we talked about choosing a broker, and I introduced you to Deriv. So if you want to explore the Forex synthetic market, if you want to learn more about the forex synthetic market, the only broker that offers this is the Deriv. Yeah, so this, you can only pick a broker whose trading conditions favor you when it comes to the forex market. So there are a lot of brokers, but when it comes to forex markets, you can only choose a broker which conditions favor you. You have to like do your research, because there are a lot of brokers that you can use, and like example SNES, you can use HFM, Pepperstone, a lot of them. Yeah, I can't even mention, there are a lot of them, but you have to do your research about the broker you want to use when you are trading forex, of course, because there are a lot of brokers that offer that. But when you want to trade the synthetic indices markets, the only broker that is offering them is Deriv. So you have to open your Deriv account, and Deriv, it's a broker that you can trade. You can trade forex pair on them also. You can trade both synthetic pairs and forex pair on them also. So I strongly recommend Deriv. As a matter of fact, below this video there will be a link that will direct you to create your Deriv account, and subsequently I'll make a video on how you can set up your Deriv trading account. So that's it. And then the last thing here, last difference, is the platform. So forex can be traded on MT4 and MT5 depending on the broker. So when you're trading forex, there are different platform you can use. I think you probably heard of MT4, MT5. You can use any one of them to trade forex. But when it comes to synthetic indices, there's only one platform that can be traded on, which is the MT5. So if you don't know what MT5 is, you can go on your Play Store and type MT5. It will bring it out, then download it, because that is the platform you'll be using to trade the synthetic indices. Alright, moving forward, let us talk about some derived properties. And when I talk about derived properties, I'm talking about the list of index that we can trade on Deriv. So let me move on. I'll say there are different type of instruments that you can trade on that are available to trade under the synthetic indices. There where you'll be hearing things like the volatility indices, and there's lots more than that. You hear the boom and crash, and the range. There's just a lot of, but I think the most popular one is the volatility indices. So volatility is just the rate at which something goes up and down. So I'm just going to leave this note out go to the list of the things that. So these are just few of the instruments that are available that you can trade under the synthetic indices. So we have examples are the volatility 10, volatility 25, volatility 50, volatility 75, volatility 100. The ones that have this 1x at the back shows that they are more volatile, and there are ones that don't have x at the back. But we'll go into that as we go on. We'll go into that, I'll explain better. But I just want to add that volatility is just the rate at which something goes up and down. So for volatility, as the number increases, so does the volatility increases. So volatility 10, volatility 25, 50, 75, 100, the ones that are displayed on the screen, using as an example, you will know that volatility 100 is more volatile than volatility 10. So as the number increases, and that is the rate at which the volatility increases. So I will just explain better again that it will be more riskier to put your money in volatility 100 because it is more volatile. The rate at which it moves is faster, right? So that's just what it means. But volatility 10, the risk will be reduced, and the volatility is just at 10. So compared to volatility 100, the risk will be reduced and the market will move slower. So that's just, so as this number progresses, so does the volatility. So these are just few of the instruments that you will see under the volatility, under the synthetic indices. So yeah, all right then, I think I've introduced you to the Forex synthetic market, and I've told you how it is different from the Forex markets, and I've explained the broker that you can use, that you can trade them on. So that's just a very brief introduction, and we'll be going on to the introduction to technical analysis. All right, so this will come up in other videos. I wouldn't want to combine them together. So in our subsequent video, then we will now go on to the main business, where I will introduce you to technical analysis. Mind you, know that you need two things as a trader. You need to master two things as a trader. The first one is technical analysis, and the second one is the mental analysis, which is also psychology aspect. So but we'll begin the class by, I will introduce you to some technical analysis, and like the support and resistance, the market trends, the candlesticks, trend lines, and so on, chart patterns, and so on. So for our next class, we'll be talking about support and resistance. We'll start with introduction to technical analysis, and we'll start with support and resistance. So that will be all for today. And today there will not be much. There will not be a tax, right? Just set up your trading account, create your Deriv trading account, download MT5, because those are the two things that you would be needing to trade the Forex synthetic markets. And I hope that you understand everything that I've said so far. If you have questions, drop them for me. I will answer them, and you would soon get the next video on. You get the next video on support. And just before I go, I'm just going to show you where you can see the different properties that is traded on the synthetic indices market. When you open your you open the site, you can just type Deriv trading view on your you can just search Deriv trading view, and it will bring you to the site. So when you click on this part, you would see, you come to Deriv, you see different type of instruments that are traded on the Forex synthetic market. You can see we have the volatility 10 coming, 10, 25, 50, 75, 100. So as the number progresses, so does the volatility. Then also, aside that, we have other synthetic instruments like the boom and crash and all that. So the most common one is this volatility, which is the most traded one ahead, and that is what I'll be focusing on. So see you in our next class. Where we'll start the main business, which is the technical analysis. You get familiar with the technical analysis and how to use them. All right, so that'll be all. Thank you.